Okay, we're about to get started. So this is a session on how to identify red flags in the offshore world. And to your right, we have Hugh Dickson, who's a partner at Thornton. And further to the right is Jess Shakespeare, a director at Kinetic Partners, both based in the Cayman Islands and both insolvency practitioners. And the reason for me including this on the agenda is that huge amounts of money are lost each year in circumstances that I find typically very difficult to believe. It often seems to me that people do no due diligence whatsoever, or they attempt to do due diligence and fail completely. But an enormous amount of money is lost each year in schemes that, to me, seem to be overtly silly. Quite frankly. So we're going to discuss today how to identify potential problems. And it's been my experience as a journalist, when I'm dealing with other journalists, which is frequently, I mean barely a day goes by without a journalist contacting me with some offshore inquiry. And it seems to me that all offshore jurisdictions are treated the same by many people. And anyone in the offshore world knows that within that world there are significant differences between jurisdictions in terms of courts, quality, professionalism, efficiency, telecommunications. So we're going to start off by talking about jurisdictions. And if either Hugh or Jess would like to kick us off on some of the differences.
Well, I'll start, David. I mean, I think the title of this talk is actually quite an interesting one, which is how to identify red flags in the offshore world. It almost implies that the offshore world is somehow an inherently dangerous or dodgy place to do business. And the reality is that it's simply not. As David says, there's a hell of a difference between jurisdictions. Something like 80% of the world's hedge fund business, for example, goes through the Cayman Islands. A fair proportion of the world's trust business goes through other offshore jurisdictions. Not all offshore jurisdictions are inherently dodgy. I think one of the problems is that the highly publicized cases tend to involve some element of offshore, and that contaminates the perception, at least, of good business. However, I'd like to take this opportunity to perhaps puncture a few myths about jurisdiction. Jurisdiction in itself is not inherently a red flag. A business incorporated in Cayman is not inherently dangerous or dodgy, but even those businesses that are incorporated offshore, a lot of people in this room probably don't appreciate that the assets aren't actually offshore. Typically the assets are onshore somewhere. And quite often, the assets are onshore in a regulated environment. And even that has not been enough to provide protection to investors. Let me give you some examples. I'm one of the liquidators on Stanford International Bank, which I think is probably fairly well known fraud. Stanford International Bank was originally incorporated in Montserrat, not exactly renowned for its international banking activity. lost its license there, and then moved to Antigua. Again, not exactly known as an offshore banking jurisdiction per se. So you could say, well, there's a red flag for people who invested in Stanford. Yeah, it was in Antigua. They should have been on notice. But a large amount of the economic activity of Stanford took place within a regulated environment, namely in the United States, in the UK, and in Switzerland. And none of that was sufficient to actually protect investors. In Stanford's case, I believe the SEC were first put on notice that there might be something dodgy about Alan Stanford and his activities as early as 1997. And yet it took over a decade and I believe 4 separate SEC inquiries before Alan Stanford's activities were finally brought to an end. So the offshore versus onshore element of it, you have onshore regulated activities but not detected or stopped. I'm also the liquidator on the Weavering fund. Weavering incorporated in the Cayman Islands but traded on the Irish Stock Exchange and administered largely out of Ireland as well and managed from the UK. Heavily regulated enterprise, Weavering, a very, very simplistic fraud. Really, really simple, almost childish or childlike in its simplicity, and yet survived 3 years' worth of audited accounts before the bottom fell out. And the bottom fell out because of a liquidity crunch. The scheme could only grow so big. When people started asking for their money back, with the liquidity crisis, the money wasn't there because, of course, it was all illusory. And the new money had been used to pay off exiting investors. Regulated, not detected. So don't just look at offshore and say, because it's offshore, there's something inherently wrong. As David alluded to, there's variable quality of offshore too. There's one thing to look at an entity which is incorporated in an offshore jurisdiction well known for a particular type of business, and it's that type of business and it's incorporated there, and that jurisdiction is known to have good laws, regulatory enforcement. It's quite another to find it in some odd location where there is an absence of regulation, or absence of thorough legal basis. That, I think, is the bigger red flag. Now, I'm not going to name and shame some jurisdictions, but there are a number well known, I think, exposed to most people in this room, that are simply not credible jurisdictions, not because there's anything inherently criminal about them per se, but they simply lack the infrastructure to properly police the activities that take place there. And that, combined with the elements of confidentiality or corporate secrecy, if you prefer, that takes place in the offshore world, is a recipe for disaster. Laws and regulations, I said, well, it's all very well to look at a jurisdiction that's got good law and regulations, but those laws and regulations have to be enforced. So if you're looking for red flags, look for a jurisdiction that tells you it's got strong regulatory presence or enforcement, and it's got good, sound judiciary and good corporate law, and then see how many times they've actually intervened to stop a fraud or even just a straightforward financial collapse taking place. If there's no track record of intervention or aggressive action to recover assets on behalf of investors, that, in my book, is a red flag. And again, just drawing comparisons with onshore, I have the fortune or misfortune to be a liquidator in a case called DD Growth. DD Growth is a fraud. Took place in the UK, but it's a Cayman corporation. Now, again, quite a simplistic fraud. Never prosecuted by the Serious Fraud Office. Weavering, another classic case, simplistic fraud, as I said, only now being prosecuted by the SFO, who had originally dropped their inquiry, saying there was inadequate evidence to warrant an investigation and/or prosecution. And the only thing that seems to have changed the SFO's position was the insolvency practitioners involved winning a civil case in which the judge made a finding of fraud. And then leverage was implied by investors and by the insolvency practitioners concerned to shame the SFO into actually taking action. So I think my parting bon mot on jurisdiction would be, don't worry about the regulation, don't necessarily worry about criminal law enforcement, but make sure when you invest in a jurisdiction that it has good, solid insolvency law. Because quite often you'll find it's the insolvency practitioners who are actually prepared to go the extra mile and take action to recover assets and deal with wrongdoers. Jess, you got anything to add on jurisdiction? Or?
No, I think that covers it.
I've just got a few things I'd like to say. Probably the most transparent and jurisdiction in this neck of the woods, an offshore jurisdiction, is Bermuda. And I think it might come as a surprise to quite a few people, because it certainly comes as a surprise to journalists who I deal with routinely, that in Bermuda, ever since I've been covering the jurisdiction, which began in 1990, any member of the public was entitled to view and receive a copy of, if requested, for a statutory nominal sum, something like $10, the share register of any company domiciled in Bermuda, with some exceptions, such as mutual funds, because a share register of a mutual fund is basically a list of its clients. So it's quite understandable that that would be exempt. You can obtain a copy of a list of officers and directors. And that, as a jurisdiction, is much more transparent than Delaware, for example, and certain other states. I mean, Delaware is pretty much a brick wall when it comes to, certainly me, trying to find out information. It's just not available. So, Bermuda compared with Delaware, in terms of transparency, Bermuda is the winner hands down. When I'm dealing with companies in Bermuda, I always assume that they are legitimate. That's my starting assumption. There are other offshore centers where I, as an investigative journalist, my starting assumption, rightly or wrongly, but just based on my experience, my knowledge, is that that they're not legitimate, and I don't wish to offend anyone, but I am trying to impart, useful information to you. That's my number one concern, not offending somebody. So, if I come across an entity, particularly a regulated entity in Antigua, St. Kitts and Nevis, St. Vincent and the Grenadines, my starting point is that they are not credible. Particularly if you're accepting, you're soliciting money from third parties, I can't think of any reason why a legitimate firm would want to be based in a jurisdiction that doesn't enjoy a good reputation, because it would be a liability. It would impair your ability to raise money from third parties. So the only reason I can think of for going to some of these jurisdictions is you want to be left alone and be left to your own devices and to do what you want with other people's money. And I would say in the sort of Bermuda Caribbean region, there is a significant difference in quality between, I would put the Cayman Islands generally on a par with Bermuda, although not when it comes to transparency, but when it comes to quality of justice. The Bermuda Supreme Court is very good. The Grand Court of the Cayman Islands is very good. You're not going to get a lot of enforcement, even in the best offshore jurisdictions. That people go offshore. The balance is always in favor of the entrepreneur, the business person. You could ultimately say, debtor, and the balance is always slightly, tipped against, a creditor. Everything is slightly in favor of the business person, and there's nothing wrong with that. Major countries tend to wrap everybody up in bureaucracy. So I would also speak quite highly of the BVI, and we had a panel on corruption earlier. The BVI has carried out corruption investigations and successful prosecutions. And, as an investigative journalist, I was very impressed when they did that. Firstly, that they had the will to do it, and they actually were successful. That, in my experience, was quite a rare occurrence in the offshore world. And so I just wanted to add that. My hands aren't tied like the two gentlemen to my left. Now, I know you wanted to speak about, the offshore world is known for products that are considered by most people to be complex. So what should we be looking for in terms of complex offshore products? Jess, do you want to take this?
Yeah, sure. As you said, the Cayman Islands renowned for complex products, structured finance type investments. But I first of all wanted to touch on the issue of leverage throughout entities in the Cayman Islands. Although a simple concept, leverage gives rise, or has given rise, to a number of failures in the past. Pre-2008, funds were up at 25 times leverage. Post-2008, with leverage being seen as one of the major causes of collapse of funds at that time, leverage was reined in, and often service providers such as independent directors in the Cayman Islands would only agree to go on a board if leverage was no more than 5 times, and were also requesting enhanced disclosure in the offering documents that would advertise the fact that the fund is not going to go over 5 times. But since that time, leverage has been creeping back up to the type of levels that we saw in 2008, and the latest statistic from the New York Stock Exchange is that debt margin, a measure of leverage, is now at $366 billion, which is only $15 billion below its highest ever peak in July 2007. And in the Cayman Islands, with there being roughly the same number of funds in Cayman as there were in 2008, this is evidence to suggest that investors might be wise to explore any investment opportunities where leverage is going to be employed. And of course, with leverage comes often the use of repurchase agreements or repos, which provide the leverage provider to have the ability, as a result of providing the loan facility to the entity, to have the ability to seize assets in the event that margins are not met. Now, although often disclosed in the offering documents are often up to 300 pages long, very complicated, and it might not be immediately apparent to investors getting into these structures that ultimately, if something does happen, if something does fail, there's very likely to be nothing left for the investor at the end of the day. Products such as credit default swaps, collateralized debt obligations, collateralized loan obligations, collateralized bond obligations, and catastrophe bonds, all well-known products, a lot of them incorporated in the Cayman Islands, but complex investment products with mountains of transactional documents and agreements which are set up to be bankruptcy remote, non-recourse transactions that can be set up for anywhere up to 50 years, the note programs involved. All of these products can form part of a fund's investment strategy, and often funds which are run by managers that are also the managers of those complex products. And we'll get into related party transactions a little bit later. But while complex investments are designed to provide greater returns, it seems that they sometimes become too complex for those that even designed them in the first place. While, of course, funds, particularly in the Cayman Islands and most hedge funds, are designed to only allow sophisticated or corporate investors or institutional investors, these complex types of products, they appear often to have less sophisticated investors can find their way into these structures, sometimes unwittingly. We have an ongoing case that I'm involved in where a group of funds, faced with the impending collapse of the mortgage market in 2008, packaged all of its residential mortgage-backed security positions into a CDO at the beginning of 2008, just at the precipice of the collapse of the residential mortgage market in the US, with a 50-year note program. Now, the vast majority of the investors in these funds that now find themselves, or the funds that now find themselves holding a CDO, are retiree IRA accounts from investors in Louisiana and the surrounding states. They invested with a manager who acted more like their personal investment advisor. And so you can imagine the type of calls that we deal with when I'm trying to explain what a CDO is to a retiree at the age of 80 in a town outside of Baton Rouge. I also wanted to talk about the issue of the valuation of assets in hedge funds. And it's a key red flag, I think. Managers that take the position that they are managing their own investments, sorry, not managing their own investments, valuing their own investments. And most often the argument is because they're the manager, they made the investment in the first place, they're the most appropriate party to provide the valuation of the asset. And here we're talking about level 3 type investments. An example of this can be a private equity investment, difficult to value depending on the nature of the business that the PE investment conducts. We're involved in a case of a fund invests into a very local software development company which may or may not one day strike it big. The manager knows the chairman in the private equity company, which brings up another issue that I'll cover when discussing related party transactions, and this was the basis upon which the investment was made. Valuing the investment is very difficult. In this instance, there's a third-party valuation firm hired to value it, but it seems to me, and in my discussions with these third-party service provider valuers, that they can almost produce whatever figure you want them to produce and be able to mathematically justify it and also bamboozle the auditors as well. There's been a number of collapses that have been specifically down to asset valuation issues. 1998 long-term capital management had a complex book of over-leveraged fixed income and currency derivatives, the issue there being valuation and transparency. Beacon Hill in 2002 was accused by the SEC of manipulated misappropriations, the problem there being mortgage-backed securities valuations inflated by a purported 50%. Amaranth Advisors Fund in 2006 was the biggest hedge fund loss at more than $5 billion due to its trading practices in natural gas futures. The issue there being the intentional manipulation of settlement prices, giving rise to erroneous valuations. And more recently, only last year in fact, JP Morgan loses $6.2 billion on its credit default swap book, which gradually becomes evident to regulators and investors. The problem there being, according to the Senate report, was what they defined as pervasive and escalating valuation manipulation to obscure losses and conceal the overall problem. As I mentioned above, the Bear Stearns Fund suffered in part as a result of related party transactions where assets were transferred between Bear Stearns structured finance entities and then into the Bear Stearns funds. Transfers of assets by managers between funds or structures they manage can give rise to concerns, as the transfer price can be manipulated by the manager transferring them. It can also give rise to the tendency to cherry-pick the assets which move in and around the entities being managed by the manager. I also alluded to transactions involving making investments with persons familiar to the manager, friends and family type investments, and a good example of this, which was the one that we were given, is an emotional type investment. For example, an avid Man United fan wanting to invest in Man United, he was always going to make the investment because of the emotional attachment, and you often find that with managers. Their investments, particularly sort of more localized managers around the States, the investments that they make can often have very emotional connections to them, and so that's definitely a red flag to look out for as well. Hugh, do you have anything to add on complex products?
Yeah, I think the issue of valuation is actually a very important one, particularly when you come to exotic types of instruments or investments, or things that are generally hard to obviously expose to the market and value. So the classics are private equity type investments, positions in land with so-called development potential.
Yeah.
Massive opportunities there for revaluing the asset, and in the course of doing that, generating a hypothetical profit, which the investment manager then uses to justify a 20% profit share, which he then takes in cash. And when the wheel stops spinning, the investors are left with the asset which turned out not to be actually worth anything at all.
Yes.
And the cash has all disappeared in terms of management fees. Another very common one you'll see, I mean, it's a bit old school, but you'd be surprised how often the same tools of the trade are used by fraudsters, you know, dating all the way back, of course, to Mr. Ponzi himself. And that is buying very thinly traded positions. Typically things like penny shares or pink sheet traded stocks. What you can then do, you see, is just before month end, you go into the market yourself and you buy a volume of it at a ridiculous price, which then sets the benchmark. So for a classic example, on the DD case I mentioned, one of the investment manager's activities was buying such positions. These would be shares, typically, if you were lucky, 100 shares a month would actually change hands. And he'd buy 1 million of them. And then just before month end, there'd be a trade, I'm not saying he did the trade, but someone did, of 100 shares at suddenly 5 times the price they'd ever previously traded at. That then sends the benchmark, and he then turns around and says, well, see, the price is now $5 a share, and I've got 1 million of them, so therefore we've got $5 million worth of investment here. It only cost me $50,000 to buy, but now I'm entitled to, again, 20% of $4,950,000 of appreciation. So it comes back to the same thing, which is understand what the asset is. What is the mechanism here? What is the purported means of generating profit? If it doesn't seem obvious and you can't understand it, then stay the hell away from it.
In terms of sort of manipulating the price by small transactions, and very often, you know, at the end of the month, just before they're valued, Lancer Offshore was a very good example of that. They had several funds in the BVI, and just before, you know, the end of each month, the end of each valuation period, there would be some small transaction at a ridiculous price, and this seemingly obvious red flag, you know, fooled. I don't know whether it genuinely fooled or people just didn't care, but, you know, the auditors, the fund administrators, everybody. And I just wanted to comment about related party transactions. You know, for me as a journalist, this is a massive, massive red flag, because it implies that the purpose of the scheme, particularly an investment scheme, is not to return value to the investors, the people who have put money in, but just to enrich the insiders through fees and commissions. And I investigate a lot of investment frauds and penny stock frauds. And man, it's just so obvious to spot. You can see these companies just raising millions and millions of dollars. And if you just go to the financials, almost the only paragraph of their financials that you have to view is related party transactions. And you can see as quickly as the money's coming in, it's just going out in legal fees to a law firm, one of whose partners is an insider in the company, or some sort of consulting fees. I mean, it never ceases to amaze me, for want of a cliche, for use of a cliche, that this isn't obvious to people, and yet securities fraud is, in my experience, the single biggest source of loss of money in the realm of financial crime that I know of. The amounts are enormous. We're going to turn to credible service providers. So if one of you could take that up, and I can't imagine either of you are going to name any names, but I've got a couple of names that I'd like to throw around after you're done.
You can do that after, yeah. From Freeling and Horowitz with 3 employees to Arthur Anderson with 85,000. 2 extremes, but the same problem. They were both convicted of accounting fraud, obviously leading to the collapse of both firms. No one would have batted an eyelid or been concerned about Arthur Anderson auditing your investment. But generally speaking, a large fund using a small service provider should prompt at least a second glance and perhaps some enhanced due diligence. Startup managers can sometimes find it difficult to retain service providers, particularly directors, as the fund has not had the opportunity to build up a track record. Startups are susceptible to having weak infrastructure systems as they look to minimize costs until investment starts flowing in. Roles such as the Chief Compliance Officer can be put on the back burner until such time. A manager in a fund's first year can often be the most error-prone due to these reasons, and so funds and managers with a track record, without a track record, can certainly be a red flag that warrants a little more due diligence on the part of an investor. Startup service providers such as directors and administrators could also benefit from enhanced due diligence if you're going to be making a potential investment into a fund that has got either a very new directorship shop or new administrator as one of its service providers. Delay in the release of financial results and administrator statements can be grounds for concern, and the longer it goes on, the more likely there is to be something sinister as being the reason behind it. While I don't have the statistics to confirm the following, because they're simply not available in the Cayman Islands, I know that a lot of Cayman hedge funds have a board composed entirely of the manager and or affiliated persons. The Weavering decision, which has been discussed on a number of panels earlier, highlighted the risks that the scenario of having an affiliated person board can bring. The offering document will of course advise on the composition of the board, and a board composed entirely of affiliates would generally be considered to be riskier than one with some independence, and obviously therefore more of a red flag. Perhaps equally well used, though, is a board composed of an affiliated director, sometimes the chief manager at the investment manager, with 2 independent directors, often offshore directors. But more increasingly, I understand that there's a trend developing to appoint 2 independent directors from different firms to the board to avoid the possibility that one director acts as a lead and one director acts as a second, so essentially the second director doesn't really do that much. The development certainly produces a more independent board and certainly should lead to more robust decision-making. Anything to add on service providers?
Yeah, I mean, it's tempting to say that you should look at the service providers, and if you've got some brand names in there, you should get an enormous degree of comfort from it. Might be slightly controversial to say this, but I don't think that is the case. Whilst you can absolutely look at a big fund, and if it's got a very, very small service provider, like a 3-man audit shop, for example, yeah, by all means, get the red flag out and haul it up the flagpole. But if that same fund has a Big 4 accounting firm auditing it, or it has a top-line fund administrator administering it, or, dare I say it, if it has professional service directors, one of the, the jumbos that were referred to in yesterday's presentations, you can't necessarily take that as a guarantee. You have to look beyond the superficial elements and look at what the true relationship is between the service provider and the fund that your money's been invested into. And in particular, if you're dealing with Cayman, and I believe the same situation exists in BVI, see if they're indemnified. And if they are, what is the nature of their indemnity? Because it is not uncommon for those indemnities to indemnify them for everything short of criminal acts or willful misconduct. Now, that's, to my mind, absolutely appalling and completely indefensible in this day and age. The indemnification of auditors was done away with in the United Kingdom at least 60 years ago. And if indemnification of auditors is a red flag, what about the administrators? In a hedge fund, the price you pay for your investment is determined by the NAV. The NAV is usually calculated by the administrator. The reason it's calculated by the administrator and not the hedge fund manager is pretty obvious, isn't it? Because the hedge fund manager has a fairly large commercial incentive to miscalculate it. But if the administrator has an indemnity that says that absent him conspiring with the hedge fund manager to falsify that NAV, he's not liable for whether or not it's accurate. Or if he has a contract, which is very common, I can tell you, in the hedge fund world, that says he is entitled to accept as God's written truth any information given to him by the hedge fund manager, then frankly, the amount of credibility and reliance you can get from having a brand name administrator versus someone you never heard of is the square root of sod all. And the same issue applies to auditors and especially to directors. So perhaps I said maybe a little controversial to say it, but David said you can discriminate between certain offshore jurisdictions, and the likes of Bermuda, Cayman and BVI are at the better end of the spectrum. Well, they may be at the better end of the spectrum, but that doesn't mean they're far from perfect. So as an investor, for God's sake, read the small print, understand the nature of the relationships. Quite apart from anything else, if you've got indemnities like that in place, there's a moral hazard problem of enormous proportions. And then there's a very practical problem when people like Jess or myself get appointed by angry investors who say they want their money back, and they feel let down, failed by the system. The auditor should have protected me. The administrator should have protected me. And then we have to tell you, well, yeah, I can understand why you're angry, but the reality is I'm not going to be able to go out there and make them pay for their failure. It's, to my mind, a shocking situation, and one which will only change if investors demand it. There's very little incentive for the jurisdictions to change it. There's certainly absolutely no incentive for directors to remove their own indemnities, or for auditors, or lawyers, or hedge fund administrators to press for changes that will actually increase their risk and liability.
And I was praising Bermuda earlier, but one criticism of Bermuda is that they have absurdly good protections for directors, unless you can show that a director sort of knew of a fraud. It's my understanding that you're wasting your time suing them. And this was this added protection was introduced when I lived in Bermuda from 1990 to 1996, and a former president of the Law Society described it as a license for incompetence, because basically, a director could be completely negligent and you would not be able to successfully sue the director unless you could prove that he knew of the fraud. And I just wanted to name, I was going to name two, but I'm feeling rather brave, so I'm going to name three offshore providers. This is why I get sued so many times. Two of them are still operating. One's, I believe he's in prison, or he's pending indictment in the United States. What a surprise that the United States is the country that prosecutes most offshore providers, many more than the offshore centers themselves do. But Malchus Irvin Bonkamper, who operated in St. Kitts and Nevis, quite frankly, if this guy's name appeared on any document, you could guarantee it would be fraudulent. He was an accountant, and he would sign anything. And he participated in a scheme to provide fraudulent stroke bogus insurance policies, and this extremely sadly backfired when a tourist boat in somewhere in New York State on a lake or a river sank, and 20 elderly tourists died, and the boat operator's insurance policy was absolutely worthless because it had been issued by an offshore insurance company that was an insurance company in name only. Irvin Bonkamper had provided sham audits. So he's no longer operational. He's either serving a prison sentence or he's in custody awaiting trial. The other two, one is in the Bahamas, Philip Galanis, who's an accountant. He had to settle one lawsuit involving his participation in an investment fraud. I believe the lawsuit was brought at state court in Arizona, certainly somewhere in the U.S., while he was the managing director in the Bahamas of one of the big accounting firms. I think it was KPMG, but my apologies to KPMG if it wasn't. I'm pretty sure it was. Anyway, he was just knowingly and openly involved in an investment fraud. So these days he sort of started his own shop, and OffshoreAlert has exposed a company that a so-called offshore insurer called it started life as Condor Insurance in St. Kitts. Then it moved to Nevis. Even though Nevis at that time didn't license offshore insurers, the regulator turned down Condor Insurance for a license, was overwritten by the Prime Minister, I believe it, or Premier, I'm not sure the official title, but the head of the government, I think it was Vance Amory, and the financial secretary, and was told, you have to allow this company to continue from St. Kitts to Nevis. It collapsed there eventually, which was inevitable, and it resurfaced in the Bahamas under the name Condor Guarantee. And so we'd exposed Condor Insurance, so I set about exposing Condor Guarantee. Went to its website, and they listed the auditor. It was just some name that I'd never heard of. And it turns out that the auditor literally did not exist. It literally didn't exist. They just plucked, 3 surnames out of thin air to give it, an air of respectability. And OffshoreAlert exposed this, so they obviously thought, well, we'll get the next best thing to a non-existent auditor, and that was Philip Galanis. Philip Galanis, who, you know, is an accountant in the Cayman Islands, a former managing partner of a big accounting firm, replaced a non-existent auditor. And really the only difference in the audit was that he signed it instead of the non-existent auditor. And now Condor Guarantee has collapsed. And the third one, this is the one I wasn't sure about mentioning, but you know, quite frankly, I feel like he deserves it, is Michael Alburger in the Cayman Islands. And Michael Alburger, and you know, this is why we hold this event in the United States. There's freedom of speech here, and which doesn't mean I can abuse it, but it gives me, you know, adequate protection to, you know, impart credible information. I was investigating a company called Cedrus Investments. It was operated by a guy called Ronnie Jacques, running California, had arbitration awards against it and civil judgments against it, up the yin-yang. It was just one after the other. And I think it was something like 4 days after a $1.6 million arbitration judgment was entered against the company put out an announcement saying it had transferred, or that a Cayman entity had acquired the assets, no mention of the liabilities, the assets of the California company. Under the Cayman Islands law, you are entitled to see the share register of a local company, not an exempt company or foreign-owned company, but a local company, which Cedrus Investments was. And the law states that the complete share register from incorporation must be made available to the public. I sent a researcher around. Michael Alburger personally told my researcher that she couldn't see the share register unless she told him who she was working for. There's no requirement under the law. Michael Alburger does not make the law in the Cayman Islands. Apparently he thinks he does. And she was refused entry. She was refused access. She contacted me, and I said, look, I've no problem with you mentioning that it's OffshoreAlert you're working for. I object in principle, because there's no requirement, but feel free to mention the name. So I actually ended up hiring an attorney. He finally made a copy of the share register available, but it was only a partial copy. It only showed who the shareholder was from 18 months after inception, instead of from inception. So there was only one shareholder, and it was Michael Alburger's law firm's nominee holding company, which told me nothing. And Michael Alburger was actually a director of this company. And we went back to him and said, look, you have to show the complete share register. And I was told to get lost. I contacted the registrar of companies in the Cayman Islands, and she said, you know, you're on your own. Yes, you know, the law may have been broken, but in terms of enforcing it, it was up to me. So as a foreign national, this is another thing you have to take into consideration in sort of offshore centers. If you want to bring an action, you are going to be required to put a substantial amount of money on deposit with the court from the get-go in order to pay the fees of the other party should they prevail in the action. So instead of me receiving an entire copy of the share register for $10, I was faced with maybe having to place $50,000 into court in an attempt to, you know, enforce my rights. So, you know, anyone doing my business with Michael Alburger, the law firm is now Travis Thorpe Alburger or Travis Alburger something. Tony Travers, the chairman of the Cayman Islands Stock Exchange, is now the senior partner. To be fair to him, he wasn't at that time, and I intend to make another request. You know, Tony Travers is constantly talking about transparency. Well, let's see him, you know, put his money where his mouth is. You know, I'm going to make another request, and if he doesn't provide it to me, I learned a long time ago that there's nothing more powerful than publicity. Attorneys like to think they have the power. Trust me, journalists have the power. Okay, so we're going to go on to complex structures. So we could sort of race through that, because I've got a couple of Ponzi schemes that I am going to identify at the end of the session, and they're active Ponzi schemes.
Jolly good. There are, of course, legitimate reasons and uses for all the different types of entities that are used, from unit trusts, segregated portfolio companies, limited partnerships to limited companies. Often these entities are used because of differing worldwide investor preferences for these different types of entities. For example, the Asian market generally prefers the unit trust structure, and the US market is more familiar with the limited partnership structure. So use of these entities within a structure does not necessarily give concern. However, use of multiple entities in multiple jurisdictions will obviously make a structure more opaque. The following simplified chart, if you could bring up the chart, details such a structure. So if you could just click through it, we've got here a Bahamas fund, two classes of a Bahamas fund investing into a BVI fund, which goes into a Bahamas fund, into a different class, which then goes through a leveraged derivative provided by a bank, which boosts it up by a lot. It then goes into a Channel Islands fund, and then lo and behold, it then goes back into a Bahamas fund. So you can see the picture there. This is just a great big circular investment, and that's a very simplified structure. It's actually a structure that both Hugh and I are liquidating. It was the basis of the Helmut Kiener K1 fraud. There was absolutely no reason why multiple jurisdictions were used. Performance and management fees were taken at all levels of the structure, as well as other funds were created to acquire assets for Kiener's personal use through taking fees out of the various structures. And those assets comprised of multi-million-dollar homes, transatlantic jets, regional jets, and helicopters. The information to piece this structure together was there and available in black and white. But because of the use of so many structures in so many different jurisdictions, it wasn't discovered until investors put their redemption requests in.
Yeah, I was going to add, for those who might be struggling a bit with that diagram, the critical piece to look at here is the leveraged derivative diamond. So what you have is investor money going into A and B, goes into BVI for a bit of layering, goes into C, and then in steps International Investment Bank and levers it up by 3 to 4 times. So putting it in a nutshell, Helmut Kiener became an afternoon celebrity on German daytime television, basically giving investment advice to old age pensioners.
Yes.
He used that to assemble somewhere between 10 and 20 million euro. He went along to an investment bank and said, I want to become a hedge fund manager, will you help me? And they said, of course we will. And we'll lever you up 3 or 4 times, right? So he puts up his 20 mil, they give him another 80, which he then puts into this structure. And this is a really good bit, right? Once it's been round once and it comes back again, it gets re-levered. So at this point, International Investment Bank is actually levering up their own money without realizing it. So this time the 100 million comes up, and then they give him 400 million, right? And then 500 million goes around. Now, it's not a perfect circle, because along the way he's buying himself mansions and jets and stuff like that. But as Jess says, right, all that material was available, including to the not 1, not 2, but 3 major international investment banks, who one after the other put the money in. And perhaps one of the most, I hesitate to use the word entertaining, but I suppose in a sort of Schadenfreude way it is quite entertaining, is that those 3 investment banks won't tell us how much money they lost. They've refused to tell us what their claim is, because they're absolutely mortified.
Although, as we've said, if you had laid the offering documents out side by side in that pattern, you could have uncovered that fairly easily.
And if you're a German, old age pensioner, you've probably got some degree of comfort from the identities of these major banks participating, which, well, I think some of them are actually suing one of those banks as we speak.
Yeah. So moving on a little bit to once you're in, how do you get out? The concept of a red flag is hopefully to enable investors to put money elsewhere if a red flag is identified. But what happens when you're in and you want to get out? Redemption terms and the remedies available to the fund to prevent redemption are just as important to focus on as are the subscription terms. And generally speaking, a fund's constitutional documents will have provisions for suspending redemptions and the calculation of NAV and the putting up of gates to prevent redemptions above a defined percentage, as well as side pockets to divert assets for whatever reason become illiquid. Suffice to say that it's important to look at what your options are for getting out of the investment. And as I've said, most constitutional documents of funds give the manager quite wide-ranging powers to put up gates and suspensions and lock-ins, and they don't really even need to give you a reason why they want to do that. This has led to a phrase defining these funds that are gated and suspended since 2008 as zombie funds. Unless anyone's got any great ideas, I mean, the only way I can see that changing is through investor power.
Before I get to the Ponzi schemes, you know, what did Bernard Madoff and Alan Stanford have in common? They both named their companies after themselves. Now, this is a major red flag that I think, you know, most people
we forgot that
miss, because it's, you know, what does it tell us about Alan Stanford and Bernard Madoff? They had massive egos. You know, people with huge egos tend to put themselves before others. That's the last thing you want with somebody who's handling your money. And there are other examples. The first person to sue me for libel, who's now serving 17 years in prison, was a guy called Mark Harris. His ego was so out of control that one of his, everything was Harris, 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 Harris. But he had this, I don't know what the noise is. He had this strategy that he came up with, and it abbreviated to M-A-R-C, which was how his name was spelled. And, you know, it was as convoluted as the Patriot Act, you know, to get to the Patriot Act. It was like the monetary asset relocation concept. You know, his ego was so out of control, everything had to reflect his name. Robert Maxwell, for the Brits who are here, you know, Maxwell Enterprises, I think, or Maxwell Corporation, but some of his companies were named after himself. And Hugh here is the receiver/liquidator of the Axiom Legal Financing Fund, which was exposed by OffshoreAlert. Completely Mickey Mouse fraud. 80% of all the money coming in was being stripped out by insiders. And to confirm something, Hugh, that you raised earlier, you know, BDO were the auditors, legitimate firm. JP Fund Administration, legitimate firm, were the fund administrators, although they were also, a sister company was also promoting it. And then you had, you know, the DMS group that provided a so-called independent director to the fund. They provided an executive director stroke administrator to the investment manager, which was one of the main vehicles for stripping money out of the fund. And the DMS group even provided a bank through which the money that the investment manager defrauded from the fund, you know, was laundered through. You know, and these are all, you know, credible companies, and it emphasizes your point that, you know, the fact that sort of well-known companies, let's use the term well-known rather than sort of credible, are involved, it really doesn't mean anything, unfortunately, you know, unfortunately. And also on the subject of names, any company that routinely changes its name, which I see a lot of, that's a massive red flag. You know, because, you know, when you use a name in a company, you know, you spend money building up that brand. Why would you want to change it all the time? It makes no sense. The only reason you would change it is if it was a liability or was about to become a liability. Okay, so let's, we're going to pull up a couple of websites now. You can just pull up either of those two websites. Which one is this? Is that, what does that say? I can't.
Silverline.
Oh, Silverline, eh? Okay, so if you look at that chart, you know, the guy who exposed Bernard Madoff, forgotten his name, he said it took him minutes to understand that it was a Ponzi scheme. It obviously takes longer, you know, to prove it. I would argue with his use of the word minutes. It takes seconds. If you look at this, which is the so-called performance chart for the alternative, global, diversified, segregated portfolio, which is a segregated portfolio of JPSPC2, which is just like the Axiom Legal Financing Fund. This has been set up by the same group. The auditor is BDO. The depository bank is Deutsche Bank Cayman. The administrator is JP Fund Administration. And one of the directors of this fund is Clive Ward, who was the big promoter of Axiom Legal Financing Fund, which, you know, Hugh is a director de facto liquidator of. And the reason I say that is because we're dealing with special portfolio companies, which are, in the Cayman Islands, are virtually impossible to liquidate as a matter of law. So Hugh is actually breaking, to a degree, new legal ground, and he's technically a receiver, but the court has given him the powers, essentially, of a liquidator. But when you see a performance chart that, you know, is essentially a diagonal line with, you know, little or no material variation, that's a Ponzi scheme. Not some of the time, much of the time, or most of the time. It's all of the time. And I am so certain of that that I'm telling you in a public forum that's an active scheme. If I were wrong, you know, I would be publicly humiliated. We're audio and video recording this. It's going to be made available, you know, on the internet. And there's nothing ever that's wrong, you know, untruthful on the internet. But that's all you need to know, just a diagonal line. And just, I'm going to name the directors. Apart from Clive Ward, other directors: Simon Spice, or Spies, S-P-I-E-S-S, I don't know if I'm pronouncing his name correctly, Kurt Carlson, and Gary Wilkins. And then if you could flick on the next one, which is the Lombardi High Yield Fund, exactly the same thing, right? Just that their so-called performance is, surprise, surprise, the most impressive line on that chart, the top blue line that is basically, to all intents and purposes, a straight line with little or no meaningful variation. So that's a red flag in and of itself, just that so-called performance graph, just like the other one that I showed you. And then, you know, you do some further research, and just like Clive Ward was involved with the first one, and he was also involved with the Axiom Legal Financing Fund, which was a $175 million fraud, which is now in receivership. And previously, he was involved with Mutual Benefits Corporation. He sold that, which was a $1 billion Ponzi scheme that was closed down in Florida. You know, you do some further research again with this one, and, you know, my first suspicion is that just looking at that chart, it's a Ponzi scheme. You quickly find further information. This is part of the CMZ group, or if you're in the US, CMZ group, in the Cayman Islands, one of whose officers and directors was recently accused of a Ponzi scheme by the Securities and Exchange Commission at federal court here in the United States. and they operate a number of different companies, including check cashing, which is a very seedy business in my opinion. And they have some sort of refinery. I think they're based in the Cayman Islands. Is it a free enterprise zone, some special zone with special incentives? And the directors of this fund are Dr. David Barker, who is based in the United States, Keith Miles, who I believe is based in the Turks and Caicos Islands, Neil Johnson, I can't recall off the top of my head where he's based, and a guy called Joe Zane. And this is another red flag, people who use different combinations for their name. This guy is now known generally as Joe Zane. He's been known previously as Andy Zane, and like Andy J. Zane and A. Joseph Zane. Different combinations which, as a journalist, particularly when you're doing sensitive court searches, if you don't get like the exact name correct, in the database, you're not going to get a hit. And I've done some research on him, and he's got tons and tons of civil litigation against him over many, many years, including those that he's lost and judgments that have been entered. But that's almost irrelevant. You almost don't need to. I only look at the backgrounds of the individuals because, knowing something's a fraud and proving it, you have to do the research. But in terms of, knowing something's a fraud, I don't need to know anything about the individuals involved. That is all I need to know. Anytime you see a diagonal line, some people, look at that and think, wow, that's just the sort of investment product that I need. Steady income, little risk, high returns. And then some people look at this and think that's a fraud. And the saddest thing of all is that these are both active. And I would say that the words that are coming out of my mouth during this session are probably going to have no impact. So, any questions? Okay, well, I'd like you to thank my panelists, please.
Doesn't CNZ have a